Good day, everyone, and welcome to today's MFP Outcome Matters event. My name is Therese Grobler, Head of MFP Wealth Management, and I'm honored to be the host for this session. Thank you for taking the time to join us today as we unpack critical insights and updates that will shape the way we approach wealth management and how you build investment portfolios for your clients in the months ahead. We really have an exciting agenda lined up, but before we begin, I'd like to address a few housekeeping items. We have applied for Continuous Professional Development or CPD points for this session. To make sure your attendance is properly verified, enter your ID number in the CPD section and kindly watch the entire session. The event platform will remain accessible to you until the end of March 2025, giving you ample time to revisit the content and earn your CPD points. CPD certificates are now automatically generated and will be sent to you once you've completed the full session. Please feel free to submit any questions via the Q&A section, and our speakers will either address them in real time or respond after the session. The purpose of today's event is threefold. First, we will provide a comprehensive economic overview, analyzing key global and local trends that are influencing the economic landscape. Following on from that, we will hear from each of our business partners as they share their perspectives on the performance of the funds they manage on our behalf. And lastly, we will explore how hybrid annuities address biases like anchoring and how they reshape retirement planning by adjusting sustainable income levels across different ages. The insights from our business partners will be instrumental in reinforcing our commitment to delivering exceptional investment outcomes for your clients and supporting you throughout the advice process. As mentioned earlier, we have a compelling agenda lined up, so let's get started. To set the stage, our economists Sanisha Pakirasamy and Tsiamo Masiki will dive into the key global and political trends shaping 2025. The economic overview will further unpack the impact of Donald Trump's second presidential term on trade and international relations, political changes in Canada, economic challenges in the Eurozone, and the growth outlook for the US. Closer to home, they will look at South Africa's progress in making the most of African Growth and Opportunity Act, improving energy policies, and tackling fiscal issues. These insights will give you a clear understanding of the broader context in which we operate. Over to you, Sanisha and Tsiamo.
Thank you, Therese. Hello and welcome. We trust that you had a wonderful break. As we enter 2025, we are reminded of the revolving economic challenges and opportunities that continue to shape global financial markets. In the next while, our chief economist, Sanisha Pakirasamy, and myself will be taking you through some of the key economic trends to watch out for in 2025. Sanisha, towards the end of last year, you published an extensive report which looked at some of the more unexpected events that happened in 2024 in the political and economic spheres, such as Donald Trump's resounding presidential victory and the improvement in South Africa's electricity crisis. The report further listed 10 key trends to look out for in 2025 on the local and global front, and most of these were stemming from developments in 2024. The World Economic Forum also publishes an annual report looking at the global risks. The report for 2025 has not been published yet as we film today, but of the top risks that were mentioned in the 2024 report, which of them are likely to persist in the 2025 report?
Thanks, Tsiamo. So the World Economic Forum publishes this Perceptions of Risk survey once a year, and they divide it up into two components. So the first is on longer term 10-year risks, and the other is on shorter dated 2-year risks. And when we look at those 10-year long-term risks, I think many of these are going to populate the table for the 2025 report, such as things like climate change and how that impacts your underdeveloped economies, things like the adoption of artificial intelligence and technology, and the fact that regulation is not really keeping up with that. There is one risk that I don't think is really highlighted on there that I would add, and that is essentially around aging demographics. So many countries around the world have not got proper immigration policies in place, and this is going to hamper labor forces further down the line. Now, when we look at those 2-year or shorter term risks, I think, we really see inflation there quite prominently. But in this world of Trumponomics, I think there is, a view out there that we are going to enter a more reflationary environment. Now, it's true that some of the policies that Trump has stipulated may actually be deflationary in nature, such as deregulation or increasing fracking, which will bring down energy costs. But by and large, things like the immigration policies and tariffs are going to have more of an inflationary impact. And I think the market has already cottoned onto this. If we look at the Fed futures, they have already paid back the expected interest rate cuts for the year. So when we wrote the report, the market was looking for 3 interest rate cuts by the end of this year. At the start of this year, it was paid back to 2 interest rate cuts. And now Fed futures are almost pricing in 1 interest rate cut. So, we are now sitting at the middle of January as we film, but I wouldn't be surprised, in the next couple of weeks that the market could potentially even take out any form of interest rate cuts for the US Federal Reserve. And we know that monetary policy is largely dictated by the United States. And so that means that the prospect for further easing in other markets, such as Europe, may actually be off the table for this year.
Another interesting outlook report is published by the Euro-Asia Group, which was released in early January. But this one focuses on political risks as opposed to the World Economic Forum, which takes a more macro approach. Are there any political risks highlighted in this report that caught your attention and you had perhaps not highlighted them in your 2025 Outlook report?
Well, we always make this joke that when we're talking about the year ahead, it's not very long before you start using the T word, which is Trump or Trumponomics. And so just like any other year ahead report, Eurasia Group's report also focuses on all the ideologies behind Trumponomics. So the trade developments that are likely to stem from there, the change in foreign affairs. So a lot of that, I think, we did capsulate quite well in our own report. There are ever 2 risks that I would highlight, such as the ungoverned spaces, which is one of the 10 risks that they spoke about. Now, ungoverned spaces really talks about those areas of the global economy that are left behind as we get these centers of powers emerging. So a great example of this would be Sudan. And the war there started around April 2023, and the United Nations came out saying that around 11.5 million people have been displaced after this war has taken place. And so we are likely to see that more and more, we'll see a global rise in inequality, more poverty emerging. Now, these are things that don't necessarily hit the headlines, but I think this is a key risk that we do need to contend with and governments need to be aware of going forward. The other key risk that I think do underlie our economic forecast, but we didn't really tease it out as a specific risk, would essentially be the AI unbound risk. And this really talks about regulation lagging artificial intelligence and technological advances. And a key example of this would be what happened in Europe over the last couple of weeks, where the underground sea cables were damaged. And that's an example of cyber warfare that has taken place. So I'd say that those risks, we have sort of taken that into account when developing our economic forecast, but didn't really tease it out as specific risks as noted in this geopolitical report.
Let's focus a bit more on Trump. During the holiday break, there were a few legal developments. 1, he was found liable for sexual abuse and defamation in a civil court. 2, there was also a finding of civil fraud regarding his businesses. Moreover, he was the subject of 2 federal indictments, and he was indicted in a state election interference case in Georgia. How will these cases impact Trump's political standing and influence, both in the US and on the global economy, if at all?
Well, we're still expecting that on the 20th of January, we're about a week away at the time of filming, that Donald Trump will take oath to become the next president of the United States. And that does speak a little bit to a 2-tier justice system in the United States, unfortunately, for a number of reasons. So the first, and this is really why I think his case was treated more favorably, even if it was just a normal civilian, probably would have gotten a fine or imprisonment, He is still seen as a felon now in the law's eyes. However, he knew the federal judge that he stood before. He was given the opportunity to appeal to the Supreme Court, of which, 3 of those judges he had appointed. And then lastly, there is also a financial angle here. There was a legal fund that was set up that was both publicly and privately supported for Trump's case. Now, he will be able to still become president and put through all the policies that he wants to. But I think, the real angle here is that there are big question marks around the independence of the criminal justice system in the United States. And it is just yet another nail in the coffin for democracy in my eyes. So if we look at, the chart that we're displaying at the moment in terms of the depreciation in terms of the view on how independent are judges and prosecutors in the United States, this has fallen in the last while. And I think that this will be a continuous trend in the next couple of years under a Trump regime.
Following the US elections, we discussed the likely political and economic consequences of a second Trump term. Since then, have there been any new developments in terms of Trump's foreign policy approach? I ask because it seems that his strong comments about reclaiming the Panama Canal, annexing Greenland, and making Canada the 51st state of the United States has upset many world leaders.
So not uncommon. We've seen that Trump has made many very bold statements, and it always ends up in backlash by other world leaders. And I think that this is a little bit of a negotiation tactic from Trump's side. So I think he sort of scares the opponents, puts them on the back foot, and then gets them back at the negotiation table and then goes after the goal that he really wants. Quite often we've spoken in these events where we listen to geopolitical strategists out there like John Hulsman, and he's noted that in 2016 there was a reporter that really spoke about how Trump's dynamics played out with his allies and his opponents. And he basically said, that some of his allies take him seriously, but not literally, but the opponents take him literally and not seriously. And I think this is really playing out at this point in time, where they need to take, cognizance of what he really wants to do in the case of these 3 areas. And so if we look at the Panama Canal as an example, this is a key waterway for goods to be traded from the west of the US to the east of the US without having to go the route via Argentina. So there's an economic consequence that results from that. The Panama Canal was also built by Americans and then sold off at a later point. Now, going forward, I think what he really is after here is to ensure that he can get trade at the lowest possible cost. There's an additional angle, and that's the Chinese angle, because there are Chinese firms that are operating at either side of the canal. And I think what he's really after is to push those Chinese firms out, even though he might not actually reclaim the Panama Canal. The second issue that he spoke about was Greenland. And we know that the Prime Minister of Denmark oversees that region and said that that region belongs to the Greenlanders. However, they don't really protect it in terms of a defense system that's there and present. And I think that the US wants to have some kind of security presence in Greenland. There's another economic angle to that, and Greenland is very rich in mineral resources, especially your rare earth materials. And we've already seen that some Chinese companies have entered into venture capital arrangements in order to extract those rare earth materials, which are crucial for modern tech industries. And I think that's essentially where Trump wants to come in again. The third angle is on Canada. And if we look at Canada's performance, it's actually been quite dismal over the last while. Outgoing Prime Minister Justin Trudeau, during his term, Canada's real GDP per capita dropped from 80% of that of the US down to 70%. And a lot of Canadian growth is still very reliant on the US economy. So when Trump says, they act as a 51st state, he is not 100% incorrect on that statement, because a lot of their prosperity does in fact come from the US economy. Now, I think taking all 3 of these economies together, we also need to realize what Trump's stance is here. I think he wants to take greater control of the Western Hemisphere, and it is moving against what the Democratic Party did in the last couple of years, where they focused a lot of attention on the war in the Middle East or on Russia, Ukraine. And those regions didn't really have much of an economic impact for the US. Whereas if we look at Greenland, Panama Canal and Canada and consolidating that power in the Western Hemisphere, it does tell us a little bit about what Trump's bigger goals are here in this area.
Speaking of Canada, you mentioned Justin Trudeau as the outgoing Prime Minister. Has the news of his resignation surprised the markets? And why is this significant for global politics, especially considering your remarks in your report about the removal of political incumbents in 2024?
We did say that 2024 was going to be a heavily politically driven year. We had 72 elections, of which many of the developed markets saw their political incumbents being ousted. And this is a continuation of that trend that we're seeing now in Canada. I don't think it was, a massive surprise to markets given where the popularity vote was for Trudeau. That had grinded all the way down to 16%. And for the Liberal Party, which he represents, went down to about 22%. But I think, what we really need to take away from this is why did the popularity drop to those ultimate lows for the Canadian Liberal Party Prime Minister? And a big portion of this was that he had promoted progressive liberalism 9 years ago when he took the position and promised quite a lot. But many of those policies did not actually come through. Now, we mentioned that one of the reasons that political incumbents were ousted in 2024 was a disgruntled electorate that were experiencing a cost of living crisis. And in Canada's case, it had a lot to do with housing prices and housing costs, as well as immigration. Now, Canada's had big immigration numbers coming through, but citizens felt like there was no coherent policy around that. And numbers were just coming in, crime was going up, fentanyl cases were picking up as well. And I think that really added to citizens becoming very disgruntled with the status quo, with the politicians that were in place. Now, going forward, there needs to be a better response to what the citizens are actually worried about. And in an Angus Reid survey result, they found that 85% of Canadians are worried about the American tariffs that may be slapped onto them in the near future. And if we look at what the University of Calgary has calculated, if these tariffs come through, if the US does indeed put 25% tariffs on Canadian goods coming into the US, that could shave off about 2.6% of GDP, and that could send Canada into a recession. Now, as we look at some other contenders, going into the election later on this year, which is in October of 2025, it looks as though the other contenders are factoring in things like tariffs and what that means for the Canadian economy. So even though, with Trudeau stepping down and there's some other names that are being flouted, such as Mark Carney, who's the former governor of the Bank of Canada, even if we do get another replacement, it's quite likely that the Liberal Party won't survive the October 2025 election because they're not quite focusing on the real issues at play, which has a lot to do with the Trump policies.
As we've said before, Trump's harsh comments are a strategy to negotiate trade deals. But now, it looks like other options are being considered. For instance, can the rule on undertaxed profits be used by the Eurozone to prevent an economic conflict with the United States?
Definitely, but I think this strategy is going to be deployed elsewhere as well. So if we think about China, we saw that Trump came out with very bold statements in terms of the tariffs that he wanted to apply to Chinese goods coming into the US economy. But again, I think that is a tactic to get China at the negotiation table and say, maybe we'll lower these tariffs, but then you need to lower the concessions on American companies that are operating in China, as an example. Now, with this undertaxed profits rule, there was a pact that was signed by a number of countries, including South Africa, at an OECD meeting earlier on in January this year. And what that basically says is if you have American multinational companies operating in different jurisdictions and paying less than 15% tax, that jurisdiction can then levy a top-up tax. Now, for Europe, what they could potentially say, if they get all their leaders to agree and be on the same page with this, they could then go to Trump and say, okay, maybe we won't do the top up, but then maybe you don't give us such heavy taxes on the European imports that are coming into the US. So definitely, I think, this year we're going to see a lot of bargaining around how trade negotiations are dealt with.
The Eurozone appears to need to focus on maintaining growth in exports due to the domestic, economic, and political challenges it faces. What are the growth prospects for the region this year?
Well, we often talk about US growth exceptionalism, where growth is expected to do really well in the next while for the United States. But the counter to that is that other developed market economies may actually suffer a further economic blow. And I think that the Eurozone is going to be one of those. So we're looking for growth sub 1% in that region for the year. And that's because some of their major economic powerhouses are not doing that well. So if we think about where we can potentially get some growth from, there might be some relief on gas prices and energy prices as those come down. And we know that that took a huge chunk out of consumer pockets over the last while. But the counter to that is that if we look at Germany as an example, they've been on the back foot with technological advancement and adaptation. And we've seen that the manufacturing sector has suffered as a consequence of that. They also have major political issues at play right now. And so if we look at Olaf Scholz, who is their chancellor since 2021, he's not sitting in a very pretty position right now because the electorate there has also become quite grumpy that he's in place and hasn't actually adequately, fought for what citizens want in Germany. If we look at who's likely to take over from there, again, we've got an election taking place on the 23rd of February. It does look as though the center-right, center-left alliance, the CDU-CSU, is the front runner to take that position. And as a close second, we've got the Alternative for Germany, which again speaks to the rising populism across many of the European counterparts. If we look across the European counterparts, there are a number of economies that either have caretaker governments or no government really in place right now. I think there's 6 at the moment that are flagging. And that shows that there's no real leadership taking place in Europe. Whereas even it might not be the leader that we want in America, but we do have Trump at the helm there. And so that is likely to keep, the dollar in quite a strong position relative to the euro over the next while. Also in Europe, we've got France, which is the second largest economy after Germany. And then we also have, a lame duck president with Emmanuel Macron in that position. And even though he's only expected to do an election in 2027 and he can't stand for another term, I do think that all the pressure on him might actually bring that election forward to this year. And, in the wings, we've got the far-right leader of the National Front, Marine Le Pen, who looks ready to take up that position. So I think, we're going to see a lot of political issues coming out of Europe and European growth remaining on the back foot.
As we like to do, let's bring it back home. The African Growth and Opportunities Act, also known as AGOA, was one of the key concerns for South Africa's economy under a Trump regime. Luckily, it was announced in late December that South Africa secured AGOA benefits for another year. However, challenges in this regard remain, because to obtain an extension beyond 2025, the legislation must be approved by the US Congress, where Republicans hold the majority after Trump's victory. Additionally, South Africa's external trade faces challenges due to growth below 1% in the Eurozone, as you've mentioned, and China's growth is expected to struggle to exceed 4.5% this year, especially with the ongoing trade between China and the US. Aside from external trade, what does South Africa's growth outlook look like for this year?
We are estimating that growth will pick up from below 1% last year to somewhere between 1.5% and 2% for this year. And I think, one of the biggest game changers in this regard has been the improvement in energy supply. And so if we look at what the South African Reserve Bank were estimating at the time, at the beginning of the year of 2024, they estimated that load shedding would shave off about 0.8 percentage points of growth, and then they revised that lower to 0.5. Now, we haven't had load shedding since the end of March, which means that 0.5 could even be lower. We also saw over the course of the holidays, we had Coburg Unit 2 being synchronized to the grid. So that adds another 930 megawatts of energy capacity to the system. So that's on the energy side. If we look at where growth is likely to come from in the next while, and we chat a little bit about the consumer, for household consumption, we think that a bit more growth will come through with real wage growth improving, because inflation is likely to average at a lower 4.2% this year. We think a little bit of employment growth might help. We think an additional 2 cuts in the interest rate. And again, I don't think we're going to get much more than that, given that worldwide we've seen that interest rate cut expectations have now been severely pulled back on the back of Trumponomics and what that would mean for a reflationary environment. There's also this additional angle of the early retirement withdrawals, and we saw that pension reform coming through in September of last year. The South African Reserve Bank were looking for around 40 billion of withdrawals in the last quarter for 2024, but they since revised that to 51 billion. And we think that quite a bit of that is going to end up again in consumption. For fixed investment, I think what we really need to see here is higher sentiment now starting to translate into broader-based improvements in fixed investment. So a lot has come through from renewables, and we've seen that the energy regulator of South Africa has suggested that the pipeline for renewables is very strong for this year and next, but we need to see that businesses start to actually invest more in South Africa. If we look, for example, in other parts of the economy, we don't think a lot is really going to come through from the government side of things. We think that the budget is still under, significant stress there. And as you've mentioned on the trade side, there are a number of headwinds. Now, I think what was quite nice at the end of 2024, we got an announcement from Standard & Poor's that, surprised markets a bit more favorably. I think people expected that announcement to come, but a bit later, maybe 2025. And they announced that they're going to lift the outlook on South Africa from neutral to positive. And I think that's a step in the right direction. But again, for us to see an actual rating upgrade, we do need to see that more reforms actually come through, not just on the energy space, but also on logistics and water and a number of other areas in the economy. We also saw Moody's taking that sentiment early on in this year, that they feel quite optimistic that South Africa has started this implementation of reform process. But of course, we know a lot more needs to be done. The other angle that I think, ratings hinge on is fiscal management in South Africa.
You mentioned that better fiscal management is important to South Africa, and I couldn't agree more. Going into the national budget, which will be tabled on the 19th of February, there are 3 things I worry about. 1, the size of government's wage bill, especially given the ongoing negotiations. A decision on the basic income grant, and the financial viability of our state-owned enterprises. What are your thoughts on these 3 risks to the fiscal outlook?
Let's take them one at a time. So if we take, the government wage bill, I think we do need to give Treasury credit where it's due. And we have actually seen that, the size of the wage bill relative to non-interest expenditure has come down a bit. But of course, it remains quite sizable. And now, during the negotiation period, we've seen that government, over the course of December, lifted their offer from the low 4% to about 5%, but the labor union still wants 6%. So there is still a gap there. Treasury has said they could plug the gap by having early retirement taking place. We are still a little bit skeptical on how much that can actually, counter a larger wage bill, but we're yet to see on that one. What I think will help is if they do bed down a 3-year multi-year wage agreement, because it does mean, that we've got some certainty in the fiscal process for the next 3-year period. The second issue you mentioned is on the basic income grant. I do take a little bit of relief knowing that Treasury has penciled in an allocation for the social relief of distress grant extending into this fiscal year and the next. But of course, there are question marks around whether that is going to be changed into a basic income grant, whether that 350 Rand per recipient per month is going to be more, and whether more people are going to be eligible. And of course, that will push up the amount that government would then have to spend on that. And then the third element that you mentioned is, the ailing financial position of our state-owned entities. With regards to Eskom, even though they did get quite a chunky bailout from National Treasury already, we are quite worried about how they're going to pull out the distribution leg of Eskom. And the key worry here is that municipalities, as of November, according to the Business Day, owe Eskom about 95 billion Rand. So, that is quite a chunky number that hasn't yet come through in terms of non-payment. If we look at Transnet, I think, we've seen some positive developments with regards to the ports, particularly in Cape Town. One of the liquid bulk terminals was sold off in a 25-year lease to a private company. But then on the other hand, we've also got the Durban Port Terminal, where privatization plans here have been delayed. Transnet also, over the course of the holidays, came out with their statement, and that basically showed us that they made a loss of 2.2 billion rand for the first 6 months of their financial year 2024-2025. And this is, even with some improvements coming through on railway volumes and some port alleviation constraints. So that tells us, that the security issues with Transnet are still there. The ailing infrastructure problems are still there. And that backlog, I don't think we have a firm estimate of what it's going to take in order to resolve Transnet's problems and what government would then have to pay out in order to resolve Transnet's issues.
Sure. That gives us a lot of economic food for thought as we dive into 2025. Thank you for joining me today, Sanisha.
Always great to dissect the economy with you, Tsiawo. Thank you.
Thank you for your time today, and we wish you all the best for 2025.
Thank you, Sanisha and Tsiamo. As financial advisors, it is your responsibility to bridge the gap between these macroeconomic trends and the specific objectives your clients seek. The MFP advice philosophy, rooted in outcome-based investing, focuses on delivering tailored investment strategies that align with each client's unique goals. Today's discussions on fund performance will further illustrate the philosophy in action. With that, let's transition to our next speaker, Rupert Gissing, who will provide an update on MFP's multi-asset solutions, which include the MFP Focus 3, 5, and 7 model portfolios, as well as the Momentum Focus 3, 5, and 7 funder funds. He will discuss the outlook following the election, focusing on the current optimism as well as the challenges posed by inflation. Rupert, the floor is yours.
Thank you, Therese. Good day, everyone. Global markets delivered another year of strong returns in 2024. Continued US strength helped developed market equities, as measured by the MSCI World Index, deliver total returns of 18.7% in US dollars for the year and 21.5% in rand terms. Overall, the final quarter of 2024 finished on a weaker note after a sharp sell-off in December, following the American Federal Reserve Bank's cautious outlook on interest rate cuts for 2025. Overall, all asset classes except for global bonds delivered positive rand returns for the year. As we've come to see in recent years, where markets seem to be more and more sentiment-driven over the short term, the negative change in outlook dampened the positivity seen in November when Donald Trump's victory drove global equity prices higher. The November rally led by the US market reflected investors' views that some of the potential new Trump administration policies, such as corporate tax cuts and lighter regulation, could boost US growth. That positivity, however, quickly changed as the Fed turned more hawkish amid the persistent threat of higher inflation, supported by the possibility of the implementation of stricter tariffs. They scaled their projections for rate cuts down to 2 for the year from the 4 previously anticipated. However, US equities still managed to end the turbulent quarter in the green despite the sharp decline in December, with the S&P 500 up 2.3% in US dollar terms. These returns continue to be dominated by a select few large technology stocks. The following chart illustrates to what extent US equities, specifically the large technology stocks, continue to drive global equity returns during 2024. As one can see, the US completely dominates. Although expensive at an overall level, we are starting to see a rotation in US equities, away from the select few tech stocks. As an example, and according to research done by JP Morgan, the Magnificent Seven are expected to report earnings growth of 23% for the last quarter of 2024, compared to 9% for the other 493 stocks in the S&P 500. The following chart illustrates their estimates towards the end of last year, with a difference of 29% for 2024, reducing to 12.8% during 2025, and then normalizing over the following years. If one considers the difference since Q1 of 2024, when the Magnificent Seven earnings grew by 50% and the other 493 stocks contracted by 2%, we are definitely starting to notice a rotation in US equities, which could bode well for the market overall, albeit still with a considerable amount of risk attached to it. If one takes into account the sheer weight of these tech giants in the MSCI World Index. But, on the other hand, the United States and so too many other countries have a debt problem, and it's growing by the minute. US gross federal debt is now at an all-time high, and the highest that it's been since the Second World War, sitting at over 118% of GDP. As we can see, America never really recovered from their debt burden after the global financial crisis between mid-2007 and early 2009, which was then only made worse by the COVID-19 pandemic in 2020. The era of expansionary fiscal policy and cheap money to mitigate the shocks of these events unfortunately took its toll. I found the numbers in an article that I read recently staggering. I thought it's worth sharing. America currently has roughly $35.8 trillion worth of debt. This is roughly $106,000 per citizen and $272,000 per taxpayer. 35.8 trillion is a big number and one that is difficult to comprehend. Consider the following. If you stack $100 bills on top of each other at 1 meter high, roughly the height of a chair, you will have $1 million. At 1 kilometer high, which is just higher than the world's tallest building, the Burj Khalifa in Dubai, you will have $1 billion. And at just over 1,000 kilometers high, which is more than twice the distance that the International Space Station is from Earth, you will finally reach $1 trillion. Now multiply that by 35.8 and you have a stack of $100 bills that is 36,300 kilometers high. You are now approximately 1/10 on your way to the moon. And this tower keeps getting higher, as every 30 seconds American government debt grows by $1.4 million. So, the Trump administration will have their work cut out for them. Tax cuts are certainly not going to do anything to plug the debt gap, but Trump's pro-business and manufacture in America stance could bode well for the American economy and ultimately the stock market, and it could boost US government revenue. On the other hand, it could also enforce sticky global inflation. It's definitely not going to be smooth sailing, as the rest of the world isn't going to sit by idly and watch this plot unfold over the next few years. Speaking of the rest of the world, a late rally in Chinese equities coupled with strong results out of India helped to offset some of the losses in emerging markets. The impact of increased volatility was still felt as emerging market equities, as measured by the MSCI Emerging Markets Index, was down over 8% for the quarter. The US Fed's lack of urgency to cut rates, together with signs of sticky inflation, meant that US bond yields rose across the Treasury curve over the quarter. Global bond markets followed suit, and the World Government Bond Index ended the quarter down 5% for a return of minus 2.9% in US dollars for the year. The US dollar also continued its recent strong run, helped by the Fed's hawkish stance. The rand weakened by 9% against the greenback in the fourth quarter, in solidarity with most major currencies as markets priced in stronger US growth and fewer rate cuts. This helped to boost global equity returns in our focus solutions and also to offset some of the negative returns from global property and bonds. Back home, 2024 was a good year for South Africa. We got welcome relief from load shedding that was crippling the economy, saw a positive election outcome, and the prospect of better economic growth. This progress is reflected in buoyant returns from domestic asset classes. For equities, the capped shareholder weighted index returned 13% for the year. SA equities came under pressure in the fourth quarter, however, as December marked the third consecutive month of declines and the index ended the quarter down 2.1%. Global headwinds were amongst the main drivers behind the local risk-off sentiment, particularly in the US, as again, the uncertainty over monetary policy and inflation concerns weighed negatively on investor confidence. From a sector perspective, returns reflect a strong contribution from domestic shares. The financials index ended up 22% for the year, but down 1% for the quarter. The industrials index up 18% for the year and flat for the quarter. The resources index lagged meaningfully, declining 9% for the quarter and for the year. China's shift to less infrastructure-heavy growth remains a headwind to demand, contributing to a weaker outlook for many commodities. Overall, the improved South African outlook drove the expansion in valuations for domestic equities, though the asset class remains attractively priced. Earnings growth will be a key driver in justifying the expansion, and the resilience of local businesses in sectors such as banking and consumer staples can continue to drive equity returns. While still being the best performing asset class for 2024, listed property didn't manage to escape the negative turn of events during the last quarter, with the all property index down 0.4%, though still up 29.8% for the year. It is worth noting that the strong recovery in the asset class during 2024 contributed meaningfully to returns in our multi-asset solutions, the MFP-focused model portfolios, and the momentum-focused fund of funds. In line with global bond markets, SA bond yields rose in December, resulting in negative returns for the month, a rare occurrence, as it was only the fourth time in over 2 decades that the asset class had negative returns for the month of December. However, healthy returns of just over 3% during November offset losses, and local bonds still managed to end the quarter in positive territory, up 0.4% for the quarter and a significant 17.2% for the year, contributing to returns in our Focus Free solution, which has the highest exposure to the asset class. The South African Reserve Bank, or SARB for short, continued its rate cutting cycle over the quarter after lowering the repo rate to 25 basis points to 7.75%. Persistent global inflation trends, intensified by rising protectionist policies, pose an upside threat to local price pressures. It may curb interest rate reductions in the first half of 2025. In a decreasing interest rate environment, local cash still delivered healthy returns, up 2% for the quarter and 8.5% for the year. From a portfolio perspective, we maintained a mostly neutral tactical exposure to all asset classes during the last quarter. The impact of negative returns from local equity was offset by our fixed income and cash exposure, combined with the weakening of the rand against the US dollar, which offset losses from global bonds and property, and it supported global equity returns. Ultimately, it meant that rand returns from these asset classes were still positive. The diversified nature of our multi-asset solutions meant that the focus models and the fund of funds still managed to deliver healthy positive returns, even though the end of the year saw markets suffer from increased volatility. Following the alignment of the model portfolios and the fund of funds, both sets of solutions delivered returns in line with or ahead of their respective benchmarks and peer groups for the quarter. The only exception here being the MFP Focus 7 unconstrained model portfolio that sits in the worldwide multi-asset flexible peer group, where performance can vary significantly over the short term. These solutions also had a very strong 2024, with excellent performance for the 12 months to December, being ahead of the respective peer groups for all solutions. Staying invested and following a disciplined approach during good times and bad times is always going to pay dividends in the long term. And the strong short-term performance has also meant that the annualized numbers over the respective minimum time horizons has also improved significantly. During the last quarter, the alignment of the benchmarks for the fund of funds and model portfolios were finalized, meaning a simplified multi-asset offering with the same benchmarks irrespective of the vehicle use, be it a model portfolio or a fund of fund collective investment scheme structure. The benchmarks are reflective of what are reasonably expected return objectives over the different time horizons of 3, 5 and 7 years for both sets of solutions. They are aligned with your advised outcomes depending on the client's available time horizon for investment. As a reminder, for Focus 3, the benchmarks were unchanged, as for both sets of ranges they were CPI plus 2% before the alignment. For Focus 5 and 7, the benchmarks are now aligned at CPI plus 3.5% and CPI plus 5% respectively. Both the Focus 3 and 5 model portfolios, as well as the fund of funds, are currently ahead of their inflation plus 2 and 3.5% benchmarks over 3 and 5 years, with only the Focus 7 solution still lagging behind the CPI plus 5% benchmark over 7 years. Since inception of the Focus model portfolios, that will be 4 years on the 1st of March, they have all delivered performance ahead of their respective benchmarks and peer groups. Using our MFP Focus 5 model portfolio as a proxy for looking at the drivers of performance from an underlying fund perspective, we can see that relative to its benchmark, the Curate Momentum Enhanced Yield Fund contributed positively to performance. Pleasingly, since its introduction into the model portfolios in the middle of 2024, and as a reminder that it was already part of the fund of funds construction, the Curate Momentum Sustainable Equity Feeder Fund has also contributed positively from a manager selection perspective. The biggest detractor, relatively speaking, was the Visio BCI Unconstrained Fixed Interest Fund. I would, however, like to remind you that the fund is much more conservatively positioned than the Momentum SA Flexible Fixed Interest Fund. And during periods where bonds outperform cash, as we saw during 2024, relative to the All Bond Index as its benchmark, we expect the Visio fund to underperform. This is intentional as it's an integral part of our portfolio construction and diversification process. Having a closer look at our local equity building block, it continues to deliver satisfactory returns in line with and ahead of the capped Swix index. As a reminder, the construct is made up of 25% Net Group Investments Equity Fund managed by Laurium, 25% Truffle SCI General Equity Fund, 20% 91 SA Equity Fund, 20% Fairtree Equity Fund, and 10% Momentum Trending Equity Fund. Over 115 rolling 12-month periods dating back to 2015, the MFP Local Equity Blend has outperformed the capped Swix Index 63% of the time, with an average outperformance of 2.4% per year. This is once again a reminder of the importance of deliberate portfolio construction and diversification. We combine managers in such a way that we get the right balance of exposure to the different styles of equity management over time, including quality, value, and trending. Consider the following slide. Here we can see how these different styles and strategies behave over time, illustrating the importance of diversification. One can see how the different strategies have delivered very different returns relative to each other, measured in quarterly returns from September 2017 to December 2024. When combining underlying managers when constructing a solution, it isn't simply a case of selecting a few names and thinking we have diversified appropriately. Careful consideration has to be given to each manager's contribution to risk and return in the overall construction. In closing, from a tactical perspective, considering valuations, we've maintained our overweight local equity position. We've moved to a neutral to underweight position in property, and we are neutral local bonds and cash. On the global side, we've tilted slightly away from emerging market equities towards developed market equities, considering the current environment, while moving to neutral to underweight in global bonds and cash. Thank you for your time.
Thank you, Rupert, for that insightful update. It is reassuring to know that these solutions are managed by such a competent team of investment professionals. It's great to hear how MFP multi-asset solutions are positioned to perform well in the current market environment and deliver strong returns in the next quarter. Now, let's shift gears and turn our attention to our colleagues in London. Richard Stutley is the Senior Portfolio Manager at Momentum Global Investment Management, or MGIM, and he will provide an analysis of the post-US election landscape and offer a wide lens outlook for 2025.
Thank you, Therese, and thank you everyone for joining us. Okay, here we are in 2025. As of November, we now have a highly unpredictable 47th president of the US. Said individuals firing off social media messages, firing off more than 100 executive orders on his first day in charge. One would be forgiven for thinking that everything has changed and we need to rip up and everything can start again. I would suggest to you that in fact not that much has changed. It rarely does, in fact. Okay, so as it is a quarterly feedback presentation, let's jump straight into the quarter. For RAND investors, thinking about that period between September and December 2024, RAND investors were insulated from what was actually a pretty weak quarter for global asset classes. They were insulated by, you guessed it, the nigh on 9% depreciation of the rand against the dollar. So that helped your rand returns, but here we're looking in purely dollar terms, and you can see it was a pretty weak period. Global property securities down nearly 9%. Next, global bonds down over 5%, so a very poor quarter for bonds. Global equities down, even gold down. So pretty much across the board, things were negative. Why did this happen then? Here we go. Whenever you see bond prices falling, as we did, I showed you that 5.3% loss for bonds in Q4. Whenever that happens, it signifies that investors have increased their expectations for where interest rates are going to be in the future. Higher future interest rates means lower bond prices today. And that's precisely what happened in December. What we're showing on this chart here, this is looking at where do investors think interest rates in the US as set by the Federal Reserve, where are they going to be come the end of 2025. And essentially since 2022 and that big inflation shock we have, central bankers, governments, you and I as investors, we've all been trying to work out where is the neutral level of interest rates, critically in the US economy, given its size, its importance, but also elsewhere. What is the level of interest rates now that is going to keep economies ticking along nicely, keep inflation under control, but not crush economic activity? Because we all know that if interest rates are too high, then suddenly it's very hard for us to do much other than service our debt. As I say, what is the neutral level of interest rates? Well, in the third quarter, when you see this line going down after peaking in, say, May last year, it starts to come down in the third quarter, and that is because we saw the US economy slowing. The number of jobs being added by the US economy was coming down. The unemployment rate, consequently, was going up, and it ticked above 4%. And everyone said, you know what, where interest rates are today at 5%, that is too high. They need to come down. So expectations for where we'd be come the end of this year, 2025, they got right down, you can see there, to below 3%. Then what happened, however, in Q4, suddenly the data started to surprise to the upside. The economy started adding more jobs more quickly. Other variables led us to believe that, in fact, interest rates don't need to come down that much. The economy is doing pretty well. You add to that an unpredictable, as I say, 47th president of the United States. There's expectations that given his pledges to increase tariffs, that will be inflationary. Combating inflation will require higher for longer interest rates. And so the expectation of where interest rates will be come the end of 2025, the line there, it went back up. That hurt bonds, and also as bond yields rose, so that hurt pretty much every other investment class, because of course you can get more on US Treasury, then I need more by way of compensation to take the extra risk of going into equities. So high yields means lower prices, not just for bonds, but pretty much across the board. And that is what we saw in Q4. I told you that, the data had improved. Investors had started to think, look, interest rates aren't going to come down as much as we thought in 2025. All of that was finally confirmed by the key individuals, those technocrats at the Federal Reserve who spend their whole day thinking about where that neutral level of interest is. They came out and they said, you know what? In September 24, we thought interest rates going forward would look very much like that lower line, i.e. they'd be coming down quite significantly, coming down to around 3.5% come the end of 2025. All of a sudden in December, confirming what markets and investors had started to suspect, they came out and said, no, actually, we now think the line is going to look more like that higher line, i.e. higher for longer interest rates. So the Fed ultimately came out and just confirmed what investors had feared, that we're going to have higher interest rates and that therefore the kind of declines in asset price we've seen, they weren't wholly unreasonable. So that's what happened in the fourth quarter. In terms of our core views, there has been very little change. As I say, it takes more than a slightly egotistical president to change our views of how the world works. What do we think? We're still slightly underweight equities. The S&P is about as expensive today as it has been at any time this century. I'll show you more on that in a moment. In terms of fixed income and cash, the second rectangle there, we're about neutral. Bond yields today are about as high as they've been this century. And again, I'll show you that. That makes bonds attractive. Now, of course, there are still question marks over inflation. And for that reason, we're not overweight, but we are neutral as indicated by the horizontal arrow. Final rectangle there, alternatives. Things like select property and infrastructure shares, also areas like private equity, private debt. We like these areas, and therefore that's one of the key areas where we continue to put a bit of extra capital. I said I'd show you what I meant by equities being expensive. Very simple measure here, but nonetheless, it does paint a pretty clear picture. If you look at the 12-month trailing earnings on S&P 500 companies, that ratio, where high means you're paying more and more for those earnings, that ratio is 95th percentile based on data from the start of the century, i.e. there's only been 5% of occasions when the US stock market, the S&P 500, has been more expensive. That is the definition here that I'm giving for it being expensive. That is a cautionary sign for us, and that's why we're slightly underweight. On the flip side, when you look at bonds here, you'll know bond yields at 84th percentile. I should note here that here being high is a good thing. You want a higher yield. You want to put your money into high yield, high returns things. And guess what? US 10-year government bond yields, they've rarely been higher this century because they're currently standing at around 84th percentile. So that's me saying that bonds look reasonable value. Now, bond yields went down in the third quarter of last year. That was great for most asset classes. They went up in the fourth quarter. Suddenly, this is bad for asset classes. I'd suggest to you that as these things move around, as we search for what the neutral level of interest rate is, there's no reason they shouldn't go down in Q1 this year. That's wholly possible. If you think about it this way, we don't know exactly where interest rates are going to go over the short term, but we do think that at 4.5% today, 4.5%, US interest rates are more likely to go down than they are to keep going up. And why do I say that? Well, some of the indicators I'd point to would be, for example, the housing market. There is very little activity in that key market. You don't want to be a real estate agent at the moment because people are not buying and selling houses because interest rates are so high. So that's one indicator that interest rates are high. The next market would be, the next data points I'd use would come from the labor market, where if you look at things like people voluntarily quitting their jobs, that's come down. It's no longer so easy to find a job in this interest rate environment. Similarly, average hourly earnings, they're starting to come down because, again, there's less competition for workers because companies are now a little bit more nervous about expanding in this kind of an interest rate environment. So add those indicators to this next one, this very simple one. Look at what has been happening to inflation. Yes, it is still higher than official targets, which are closer to 2.5%. But look how far it's come down. That is in large part the result of interest rates. And if interest rates are causing inflation to come down that much, they must be pretty high. They must be restricting quite a lot of activity. You add those things together, that's why I think interest rates are more likely to come down from 4.5% than to go up by, say, another 1%, 2% from here. And that, therefore, again, underpins our view on bonds. The final point I made was around alternatives. And again, I was going to use a really simple measure here to try and paint a picture of why we believe these things. If you look here at global listed property companies, if you look at the dividends they're paying and compare that to the dividends you can get on equities, so it's a ratio of one to the other, where this line going up, that means you're getting more and more by way of dividends from your property companies relative to your general equity companies. Well, you can see there, the line is 99th percentile. In terms of data from this century, the last 25 years, now is the best time to buy property companies relative to general equities in terms of the extra dividends you are going to collect. Now, you're going to have to make a view on how sustainable those dividends are. We do that kind of analysis. But this, again, a simple way of showing you that some of these unloved areas are looking pretty attractive relative to global equities, which everyone has fallen in love with, the likes of Nvidia and the other Magnificent Seven stocks. Bringing it all together then, in terms of economic outlook, the economics, the growth outlook, it looks reasonable. Huge question marks, particularly around tariff policy coming from America. But as things stand today, the economic outlook looks reasonable. And you add to that the potential for falling interest rates, that tends to be good for financial assets. Second circle there, valuations. Valuations I've just been through. Some of the areas that look more and less attractive. Overall, I'd say we're not anticipating another double-digit year from global equities. They've been on an absolute tear over the last 2 years. But nonetheless, when you think about where interest rates are, where bond yields are, they're pretty decent. They're way above the kind of norms that were established post the global financial crisis. So on that basis, we're not expecting double-digit, but we think returns should be reasonable from here. I'd also say take this new 47th president, President Trump, I should say. The one thing we would anticipate from him is volatility, uncertainty. In that environment, cash yielding 4.5% in dollars is not a bad investment. So we want to make sure we have all of that. Final circle there, risk appetite. You add all these things together, we're pretty much neutral today in terms of the risk we're taking. Another way to interpret that is that we think the investment opportunity today, so that's what are returns likely to look like, what are we paying today in terms of current prices, we think it's about par. It's a reasonable time to be invested in our view. Okay, next moving on to the funds and returns. Just a quick reminder in terms of the funds, the range. We have a cautious fund. It typically needs an investment horizon of about 3 years. Next, we have a medium risk fund, otherwise known as a managed fund. It has an investment horizon of around 5 years. And finally, a high risk fund, otherwise known as a growth fund. And it has a minimum recommended holding period of 7 years. You can see how they work in terms of an increasing amount of equity as you go up the kind of risk spectrum. That's because equities are more volatile. Sometimes they'll be down a lot, sometimes they'll be up a lot. You've got to give yourself time in the market for those returns to come through. So starting with the quarter, I spoke about most asset classes in dollars being negative. The other key feature of the quarter was the dollar was very, very strong. The dollar appreciates by 6% against the British pound, 7% against the euro, 9% against the Japanese yen, a whopping 10% against the Australian dollar. Strong dollar means when you translate returns into dollar terms, that all of those currencies, those other currencies I mentioned, are losing value. And you can see that therefore in terms of the return from our global cash targets, they were actually negative over the quarter. And that's because global cash, that basket that includes some pounds, includes some yen, includes some euros, it actually fell by about 3% when translated into a very strong dollar. So losses over 3 months. However, at the full 12 months, 2024, and it was a reasonable year with returns ranging between 1.6% for cautious up to 10.7% for growth. In terms of the quarter, why is cautious doing worse than the other two funds? Well, remember, bonds, as I showed earlier, did minus 5.3% in the fourth quarter. In the cautious fund, it is heavily biased to those bonds. That compares to equities during the fourth quarter, only down 1%. So this was a period, as shown here, when in fact, very counterintuitively, you wanted to be in those higher risk funds with more exposure to equities, which did relatively better than bonds, which, as I say, did very poorly, down 5.3%. Markets were falling. Did we manage to add some value through things like our tactical asset allocation decisions and managed selection? Net, if you look at the column on the far right-hand side, that's telling you that overall, no, our decisions were negative overall over the quarter. Asset allocation, which tends to be on the left-hand side of the chart, things like our fixed income allocation were there. The columns are pointing up. That's because we added value through our asset allocation decisions. But over on the right-hand side, when we look at how our managers did during the quarter, managers generally underperformed across areas like fixed income, like property and infrastructure, which we call real assets, and indeed within the equity space. They didn't manage to keep up our managers. That happens from time to time. We're much more interested in how their returns look over longer periods like 3 and 5 years. Add those things together and net our decisions cost around 0.4%. This is looking at managed as an example. A quick note on longer term returns. It's a quarterly presentation, but we should never forget the long term. If we look here, managed growth doing what they were designed to do. Cautious at the bottom there, a little bit behind now its target return in the corresponding dotted line. It's close to it, but it is a little bit behind. It has work to do. With cautious, it has a minimum recommended holding period of 3 years. Now, if you look at its performance versus target over periods of 3 years on a rolling basis, and you say how often has it met its target, or how often has it been close to its target at least, and I define being close to your target as within 1%. Well, on 74% of occasions since inception in 2008 and when held for 3 years, 3/4 of the time, 74% of the time, it has managed to either meet its target or be close to it, i.e. within 1%. Where we are today is quite clearly from this chart the most significant period of underperformance relative to that cash target that we've experienced since inception. Why is it? I keep making this point. It is very clear. Bonds have lost -5% per annum over the last 3 years. In that context, while we're not happy with it, but our return of -3% per annum, you can see what's been dragging us down. It is those bonds. And in fact, we've done quite a bit better than those bonds. Over 5 years, bonds have returned -2% per annum, whereas cautious is now slightly positive. So again, it's being hurt by this big underperformance global bonds. It has done somewhat better than that. Now, bonds have been atrocious in this most recent period, but remember where we've come from. We've come from bond yields of 0 up to today, bond yields materially higher and offering decent real returns. For bonds to deliver the same weak returns from this starting point would require interest rates to go up by another 4% from current levels. I can tell you, I think that is extremely unlikely. Here, finally, then we just look at returns over the minimum recommended holding periods. Again, cautious is where the real pain is over 3 years, that context of poor bonds. We've also underperformed the peer median over that time period. I can tell you that in terms of since inception versus peers over rolling 3-year periods, we either meet or are very close to the performance of peers, again, using that 1% margin on 85% of occasions. So this is an unusual outcome. It's one that is down to us seemingly having more bonds, maybe having less in US dollar denominated cash than these guys. That's worked clearly in their favor. History, however, if you look at our returns versus peers since inception, it would suggest that our more diversified approach will outperform peers with a structural regional / currency bias, i.e. putting all their money in dollars. We would expect to do better over the long term. That's what our track record since 2008 demonstrates. I'm going to stop there. Some important notes for you just to quickly look at. And then for me to say a big thank you for joining us.
Thank you, Richard, for your detailed analysis and providing us with a comprehensive outlook for 2025. Your views on the post-election landscape gives us much to think about as we navigate the opportunities and the challenges ahead. Next, I'm pleased to welcome another trusted business partner, Ali Simpkins, Head of Proposition at Curate Investments. Ali will explore whether Curate represents a déjà vu of familiar strategies or an entirely new approach. We look forward to hearing your perspectives, Ali.
Thank you, Therese. Good day, everyone. With wildfires blazing, virus outbreaks featuring in the news, and Trump back as US president, it's hard not to feel a sense of déjà vu. But today, I'm here to shift the narrative with something fresh, new, and exciting. Let's take a moment to revisit some of the highlights from the launch of South Africa's newest asset manager.
Highlights. Everything was a highlight. I couldn't be happier. I couldn't be prouder. I think we had amazing attendance. People are so excited. I think we managed to break through the clutter.
To see 2-3 years worth of work come to what we've just seen throughout this week. We've seen over 500 clients. We've taken these global managers to see financial advisors, DFMs, direct clients. It's been absolutely phenomenal. The feedback we've gotten has been, it's fresh, it's different, and that's exactly what we intended. We wanted it to be fresh, we wanted it to be different, and I'm very excited and very proud of actually of what we created.
This is a part of creation, a part embedded in curation. This is the whole manifesting, the imagined reality of Curate.
Those were just a few memorable moments from Curate Investments' market launch late last year. For those of you who joined us for this milestone event, thank you. Thank you for being a part of this journey as we introduced who we are and what we stand for. At Curate, our mission is to handpick the best investment managers from around the globe, ensuring that your client's wealth is entrusted to incredible talents, no matter where that talent resides. Bringing all our chosen managers together to share their investment philosophies with our clients was a highlight, and we're excited to continue building on that foundation. If you missed the event, please visit our website to watch our world-class managers introduce themselves, including Laurium Capital from South Africa, Evenlode Investments from the UK, and Jennison Associates from the US, to name a few. As a reminder, these managers are now a part of your MFP Wealth Management proposition, alongside Equilibrium's multi-managed portfolios. On your screen, you'll see how Curate fits into your existing advisory proposition at MFP. Importantly, our single manager unit trusts complement Equilibrium's multi-manager models and fund of funds. And secondly, there's no change required from your side. Curate funds simply provide additional options. You can use Curate's funds as satellite positions or standalone investments, knowing that each manager has been carefully selected for excellence. Both Equilibrium and Asset Curate work with exceptional managers, but the difference lies in the different structures of our solutions. While Equilibrium combines multiple managers into its solutions, providing diversification, Curate assigns only one specialist manager per fund, providing clarity and precision in execution. As a reminder, the next two slides highlight each of our funds, the chosen underlying manager, and the relevant investment strategy that aligns with your client's needs. The cash and income funds managed by Momentum Fixed Income are ideal for clients seeking capital preservation, liquidity, and income. Our balance fund, managed by Visio Fund Management, blends growth and stability for medium to long-term objectives. And our property and equity funds, managed by Sesfikile Capital and Laurium Capital respectively, are designed for long-term capital growth needs, and both have a combination of local and global assets. Following on from this is the list of our international funds, each of which help clients diversify globally. Robeco's Global Sustainable and Emerging Market Equity Funds offer developed and emerging market equity exposure at low cost. And the newly launched Global Value, Growth and Quality Equity Funds explore different equity styles and will be listed on the MFP Wealth Management list soon. Let's start by unpacking the three funds that form part of our cash and income funds: the Curate Momentum Enhanced Yield, the Curate Momentum Flexible Income, and the Curate Momentum Income Plus funds. They are managed by Momentum's fixed income team, managing over 86 billion rands of assets. These three funds continue to deliver reliable inflation-beating performance. As at the end of last year, each fund outperformed inflation by 2.4%, 3.9%, and 3.6% respectively. Let's deep dive each of these funds. The fund positioning of the Enhanced Yield Fund was unchanged over the quarter. The portfolio continues to outperform both its benchmark and peer group over the showcased periods, despite the falling interest rate environment, by increasing exposure to fixed-rate instruments to lock in higher yields. In terms of the Flexible Income Fund, it also continues to outperform over the showcased periods and is currently positioned to take advantage of inflation-linked bonds as inflation bottoms, which is expected to provide attractive medium-term returns. Next up, we have the Income Plus Fund, which offers stability and diversification, making it a reliable part of many MFP portfolios. The graph shown illustrates the frequency of the monthly returns over the last 10 years. This shows that the Income Plus Fund has only delivered 2 months of negative performance in the last 10 years, emphasizing its stable return profile. The Curate Momentum Balance Fund, managed by Visio Fund Management, focuses on medium to long-term capital growth. Key changes over the quarter include an increase in domestic equity and domestic inflation-linked bonds. Overall, Visio maintain an improved sentiment towards undervalued SA Inc. shares. On the global front, they continue to monitor tech enhancements in AI, automation, and quantum computing, as well as ongoing shifts towards e-commerce and digital services. Our equity and property funds are designed for clients with longer-term horizons. The Curate Momentum Property Fund is managed by Sesfikile Capital and holds both local and global exposures. This allows the fund to take advantage of a broader opportunity set than what would be available locally in terms of property. One example includes overweighting to apartments in Germany, as there may be a reduction in rental control regulations. Similar to the property fund, the Curate Momentum Equity Fund has both local and global exposures. The fund is managed by Laurium Capital, and they have an improved outlook towards SA post the formation of the GNU. They are finding attractive opportunities in SA Inc., such as the Fashini Group, and local banking names like FirstRand. Additionally, the largest positive contributor to the performance over the quarter was the local business GE Vernova. The company spun out of General Electric and is a power company benefiting from gas turbines. This company directly benefits from the high demand for energy, especially green energy. Moving to our international funds, they provide long-term growth opportunities and include the Global Sustainable Equity Fund and Feeder Fund, as well as the Emerging Market Equity Fund, also has a feeder fund, both managed by Robeco from the Netherlands. The Curate Global Sustainable Equity Feeder Fund implements an enhanced indexing approach, and it has performed well since its inception, as you can see on the slide. It is a great alternative to passive solutions while maintaining a low cost. Last, but certainly not least, rounding out our international range is the Curate Global Quality Equity Fund, managed by Evenlode in the UK, the Curate Global Value Equity Fund, managed by Lyrical from New York, and the Curate Global Growth Equity Fund, managed by Jennison Associates in Boston. These funds are actively managed solutions, focusing on a particular style that resonates with each of their unique investment philosophies. These dollar-denominated funds launched at the end of last year and, as mentioned, will soon feature on the MFP Wealth Management list. In summary, this is the current Curate solutions. Each Curate fund is managed by one specialist manager, ensuring focus and precision. And each fund aims to address specific needs aligned with the MFP Wealth Management strategy. So, why Curate? As displayed, Curate has a comprehensive fund range that complements the multi-management solutions available to you. There is a strong focus on excelling at advice with an advice-led proposition, as we aim to assist with building and protecting our clients' financial dreams through simplified products. Furthermore, we handpick independent, single managers with their own investment philosophies and differentiated ideas. And lastly, Curate is excited to introduce new global managers to South Africa for the very first time. In closing, we're committed to partnering with you to deliver the best possible solutions and achieve long-term success for your clients. For more information on Curate or any of our funds, please reach out to the fund specialist in your region. We look forward to partnering with you as Curate Investments continues to grow. Thank you for your time.
Thank you, Ali. And now, please join me in welcoming Janine van Heerden, Head of Business Development at Momentum Securities. Drawing on her extensive expertise in developing innovative investment solutions, Janine will provide an overview of Momentum Securities, showcasing their unique offering and the value they can bring to the investment landscape. She will also illustrate how these solutions align with the MFP advice philosophy, integrating seamlessly into your investment proposition to help clients achieve their financial objectives.
Thank you, Therese. Hello, everyone. Are you ready for a story? Well, long time ago, actually not such a long time ago, Momentum bought over a portion of a stockbroker called Imara SP Reed. They've been in existence since 1938. But ever since they formed part of the Momentum brand, we've been developing and growing to work in partnership with financial advisors. As you can see from this diagram, there's been many developments that we've been working on and will continue to work on. Our aim is to form a strong bond with financial advisors and their clients to offer them a unique solution that is not available anywhere else in the Momentum Group. This integration opens up the opportunity for you to talk to your clients about shares. Because let's face it, if you aren't talking to them, somebody else is, and that is a risk for your business. So what is your role? It's simple. You continue to provide the client with holistic advice relating to retirement and investment planning, taking into consideration the client's tax, estate planning, liquidity needs, as well as risk profile. But once you've determined those needs, you simply refer the client to us to discuss a unique solution that can either stand alone or be blended with the client's current investment products. For any directly managed business we take on, we will compensate you with an ongoing referral fee, which further cements the partnership between you, the clients, and ourselves. It is our license and advice that applies to that portion of the client's investments that we manage, not yours. Yet you will not be excluded from the process, as the client remains yours and you will be the primary contact for this client. So let me guess, your next question will be, why shares? I guess it depends on where you want to play. According to ChatGPT, investors mainly fall into the following categories. On the one hand, you've got the first-timers or speculators, normally focusing on short-term growth with smaller amounts to invest. And then, on the other hand, you've got the long-term high-net-worth clients that have more significant assets to invest. The goal is usually to build assets to provide income later in life or build a legacy. The needs and the goals of these two groups are different. And although we can cater for both of these, you as a financial advisor play a crucial role in guiding clients to receive appropriate and professional advice. You see, for you to manage a portfolio successfully, it would mean knowledge and time that most clients don't have. It is better to pair up with a professional to construct a custom-built portfolio that can be managed full-time without the client feeling as if he's being placed into a cookie-cutter solution of one size fits all. Currently, the decisions available to clients are vast and can be very confusing. And yet, another reason for your guidance. But the importance of investing in the equity markets cannot be ignored. It is how you go about doing it that becomes vital to achieve the goals. Even Warren Buffett says, today people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. I don't think I need to say anything else here. It's been proven time and time again that equity is the only asset class that can keep up with inflation over time. Perhaps I'm preaching to the converted. But for those of you that are not convinced, I've got news for you. Whether you like it or not, you are invested in the stock market already. Don't believe me? Let's have a look at these figures. According to the JSE, 48% of the JSE is made up of institutional investors. That includes unit trust funds and retirement funds. 38% are foreign investors and 14% others, which are individuals, trusts, and foundations. This shows you that the chances are pretty good that you're already exposed to the equity market. But then what am I trying to say? Have a look at what the wealthy are doing in America. 37.6% of the stock market are held either directly or indirectly by individuals. What is interesting, however, is that the top 10% wealthiest Americans own 93% of those stocks, with the bottom 50% only 1%. That means that if you're serious about building wealth for your clients, then you have to consider an equity investment. And you don't have to go it alone, and you don't have to be exposed to unnecessary risk. There's also this perception that access to the stock market is exclusively for the wealthy, but this is not the case today. At Momentum Securities, a client can start a portfolio with no attached minimum, or for as little as 250,000 Rand, they can access the professional services of a portfolio manager to start building their legacy. A question that I get asked often is why shares and not just invest in a unit trust fund? My question to you is, why does it have to be either or? Currently, you can access our local and offshore share portfolios either directly, via asset swap, or through Momentum Wealth and Momentum Wealth International's products, except for the flexible investment option. Momentum Wealth's products allow you to build an investment portfolio for a client that combines everything: unit trust funds, direct shares, ETFs, managed share portfolios, and even structured products, all in one place. So if this is the case, when would you want to use the services of a professional dedicated portfolio manager? The recent TikTok ban, although short-lived, has brought attention to the newest wave of investors that are focusing more on responsible and selective investing. It has also placed focus on the motivation of decisions that's made on government level and the impact it has on the market. You see, most of the senators that voted yes on the ban made large investments into Meta stock before the time, which is the competitor. It does give new meaning to insider trading. Whether they made the decision based on the prospect that Meta shares will increase due to the vote, or whether they were hoping that Meta could become a shareholder at TikTok and they can benefit from it that way, we'll never know. But clients now want to have the control to decide where they invest, especially the high net worth clients. We saw the same trend during COVID, with the client specifically asking us to exclude Pfizer from our model portfolio as her husband passed away from COVID. The bottom line is investors are asking way more questions, and they've become a lot more conscious of their decision-making process. So again, why a share portfolio and not just a unit trust fund? With a share portfolio, you and your client have the control, and with that, there's complete transparency, with the further benefit of direct ownership. A typical unit trust fund usually only shows you the top 10 holdings, making it difficult for a client to know exactly where their money is invested. ETFs usually buy into an index where there is no discretion for the client either. This also means that you might be exposed to underlying shares that fall outside of your views of ethical investing. Having a share portfolio gives the client the opportunity to also take advantage of market movements, as they are not influenced by other investors and therefore not limited in their movement. Large unit trust funds are not as nimble to use those opportunities, which makes it ideal for you to pair a share portfolio with a unit trust fund and other instruments. All of this can happen with a direct call to the portfolio manager to implement strategies faster than a typical fund will be able to. It is very seldom that a unit trust investor has a direct contact with the portfolio manager, and even less likely that they will have any type of influence on the investment decisions. With Momentum Securities, you have a selection of portfolio managers that you can choose to partner with. Neither the client nor yourself needs to have the knowledge or the time that goes with running a managed portfolio, but you will have complete insight and access. But wait, there's more. Your client can access other asset classes other than listed instruments. You can even build in protection using derivatives, structured products, or purchasing government and corporate bonds. Income and capital protection is usually provided by investing into dividend stocks or making use of the guarantees provided by government bonds. Having a share portfolio, therefore, doesn't mean that it has to be high risk. It does, however, mean that we can construct a solution custom-built based on your client's specific needs and profile. This allows you to offer your client a full spectrum of investments available in the investment universe, which is a lot more than what the average advisor is able to do. It remains your role to guide the client, whether to use a tax wrapper, allowing for the benefit of the 5-fund tax approach, avoiding executors' fees, citus probate, or to opt for a direct share portfolio, providing the client with additional benefits, such as CGT harvesting, an offshore bank account, and securities-based lending. We prefer discussing the client's current portfolios and investment objectives before constructing a portfolio that can align with the rest of the client's investments. This will ensure that we complement and balance the portfolio and reach the optimal outcome. The portfolio manager in your region will make contact with you to see how we can help you identify potential clients and how to take the first steps to approach those clients with our custom-built solution. It's not just built around your client's needs, but can also be adjusted based on the needs of your practice and client base. Whether the client would like a capital guaranteed investment, conservative investment, income-driven investment, or downright aggressive portfolio, the choice is theirs. In support, we have developed an online portal for advisors to view their clients. We also provide online access for clients. If they prefer, they can download our mobile app. Either myself or one of the portfolio managers will make contact with you over the next 2 weeks to get the ball rolling. Look out for a mail from us. We can't wait to partner with you. Let's have a look at the short video that gives you a preview of our advisor site.
Welcome to the Momentum Securities Advisor Platform. This platform enables you to manage your clients without the need to contact your Momentum Securities portfolio manager or client services team. Should you have access to VIA, you can access the platform from here. Alternatively, you can access that platform via our website. This is the login page. The platform requires you to sign in. If you do not have login details, please contact our client services team on 011 550 6270. This is your customized dashboard. It provides you with a high-level overview of all of your indicators. This is how you access your client list. You are able to select a client in order to view the client's details. From this navigation pane, you are able to view further detailed information regarding this client, such as in-depth portfolio view, access to their historical monthly statements, as well as tax statements, historic orders, as well as their corporate actions, elections. This tab takes you to the Payments Request section. This allows you to enter in a payment amount and will provide you with the information of the total cash available to this client. This cash request will go through to the Momentum Securities payment team to action. If the request is done before 11 a.m., the payment will still take place the same day. Should the request be submitted after 11 a.m., the request will be actioned by the following business day. This Groups tab will allow you to customize your client base into groups based on any criteria that you require. This tab, titled Service Requests, will take you to an application page. This will allow you to pre-complete a mandate for any of your clients by selecting the New Applications tab. You are also able to track previous applications from this page. Should you click on a client application still in progress, you will be able to add additional information into the application by selecting Continued Application, or you will be able to email the pre-completed documents to your client by selecting Request Client Review. Your client will then receive an email including a link to their own profile that is hosted on the Momentum Securities website and will be able to complete any details that you were not able to complete, sign the document, and submit VICA documentation. You and your client would have now completed the e-onboarding process. You are able to view market data from here. This includes indices, forex rates, as well as best and worst performing shares. You are able to access all Momentum Securities news and research from here. This mailbox will include any messages pertinent to you. Should you have any queries regarding this platform, please contact our client services team on 011 550 6270.
Thank you very much for your time and your attention.
Thank you, Janine, for sharing such a clear and a compelling overview of Momentum Securities. Your insights have given us a deeper understanding of how these solutions can add real value to our investment strategies. It is then my pleasure to introduce Martiens Barnard, a marketing actuary at Momentum Investments, as our final speaker for today. Martiens will share valuable insights on hybrid annuities, explaining how they can enhance retirement planning by addressing common biases and adjusting sustainable income levels at different ages. His presentation will provide a clearer understanding of how hybrid annuities can improve the security of retirement income and help navigate the complexities of long-term financial planning.
Thank you, Darius. Hello, everyone, and thank you for joining the session today. I'd like to share some new insights on hybrid annuities. The first topic is to discuss the behavioral bias known as anchoring, and the second topic is to explore how a hybrid annuity alters the entire retirement planning framework by changing the starting income from the market-linked assets. So let's start with anchoring. Picture this. You're at a fancy restaurant, the kind where the waiter hands you the menu like it's a VIP invitation to a secret society. You open it, and right there at the top is a steak priced at 1,000 Rand. You laugh nervously. And then you look further down the menu and you see another steak, this time for 500 Rand. And suddenly you're like, oh, what a bargain, it's practically free. But let's be honest, 2 hours ago you thought 100 Rand for a burger was outrageous. Now that 1,000 Rand steak, that there is the anchor. It just tricked your brain into thinking that 500 Rand is pocket change. And now, instead of saving money, you're eating a 500 Rand steak and pretending it tastes like victory. Now, anchoring has a powerful effect on our perception of things, and it influences our decisions. Correcting it can be tricky, because it's a natural cognitive bias, but there are some practical help that you can follow to counteract the influence of anchoring. The first is to be aware of the anchor. Recognize when an anchor is present. Just knowing that the first piece of information is an anchor can help you to reduce its effect. The second thing you can do is to use data. Look for additional sources of information that aren't tied to the anchor. For example, if you're buying a car, research prices from multiple dealerships or online platforms. And the third, my favorite, is to set your own anchor. Go into the decision with your own benchmark. If you are negotiating, set a target price in your mind before hearing any offers. By consciously applying these strategies, you can loosen the grip of anchoring and make more balanced and informed decisions. Today, I'm going to use a combination of these strategies to de-anchor us, and then to further strengthen the case of using our hybrid annuity. Going back to our first piece of IP on hybrid annuities, we showed how a 35% exposure to our guaranteed annuity portfolio, or the GAP, could help retirees maintain a reasonable standard of living for an extra 10 years or more. When I did this research in 2022, I was personally already convinced that not just from a risk perspective, but also from a return perspective, that we've launched an exceptional product that can really make a meaningful impact on the lives of our clients. That was at a time where a 5% escalating life annuity gave a starting income of 7,160 Rand per month. And I'm hoping this number, the 7,160 Rand starting income, and the potential impact it has on the success of our retirees, as shown from our data, that is the 10% additional years, can help us all de-anchor from the rate hype that was last year. So let's look at the current rates and compare it to the 7,160 Rand and to the long-term historical starting income that has been available on life annuities. At present, a 65-year-old male gets more than 7,400 Rand on a R1 million investment. That is about 300 Rand more than what a retiree got at the time when I did the research, and 700 Rand per month more, or 10% more, than the 22-year average. The fact that we know how rates fell by a lot feels like, the current numbers can't offer great value to clients anymore. But judging over the long term, this is still very high rates. Apart from the 1 year, it is basically the highest rates that we've had in 23 years. However, it's easy to remain fixated on the rates from 10 months ago when they were exceptionally high. I'm hoping with this new data in mind that we can de-anchor from the 2024 rates, and that the next section will show you that we are currently providing clients with significant value for money whilst providing them with income security. As mentioned, the second topic is to explore how a hybrid annuity alters the entire retirement planning framework by changing the starting income from market-linked assets. This scatter plot shows the income drawdown distributions across the various ages of our living annuity book. Each bubble represents a cohort of clients, with the size of the bubble showing you how many clients fall into this cohort, and with the vertical axis showing how much income these clients are drawing, and the horizontal axis showing their age. Clients drawing 2.5% and 17.5% from their annuities were excluded from the analysis. This gives you a clear view of what the client base looks like. But when you overlay the return they need to maintain this income and to provide a 5% escalation on it until the age of 90, one gains an understanding of what level of income is sustainable at each age and what level is not. Here you can see, based on the coloring of the bubbles, what return each grouping of clients need to maintain their incomes. The green and dark green bubbles are income levels that are sustainable based on our and international literature. What is also notable is that younger clients require higher returns for the same income levels, which makes their probability of success lower. Thus, they have more orange, yellow, and red bubbles there in the younger ages. The yellow bubbles implies a return of 9 or 10%. It feels like, it's potentially possible in the long run, but one needs to know that this is a net of fee return, implying that long-term returns of 10, 11, or even 12% will be necessary to maintain this income. But today I want to continue with a case study that some of you might have seen before and to give you a few new insights that we've learned. Our study involves Greg, a fictional client aged 65 that is drawing 7% from his living annuity. He's a very typical client as he is part of one of the biggest cohorts on the book, and in fact he needs a return of 11 or 12% to maintain his income. To be very accurate, Greg needs a return of 11.2% after fees to maintain his income until the age of 90. Here you can see what happens at 11.2% return. He maintains his income till 90, after which the income would rapidly start to fall due to his capital running out and the 17.5% cap on living annuities. As interesting is the fact that the market value reaches its maximum value in the mid-70s, after which the income starts to really suffocate any potential capital growth. But as the slide states, what is in a percentage? What happens when markets don't play nice? What happens when you miss your target return by just 1%? Here, if this happens, Greg runs into income problems from the age of 84, 7 years too soon. If we miss the return target by 2%, the problem starts at 81, 10 years earlier than planned, and the income is less than half of what was bargained for, in fact only 44% at the age of 86. The potential to leave a material legacy is also slim in the long run if markets don't perform as intended. So let's look at the alternative, where Greg decides to use a hybrid annuity and selects only a 35% allocation to the gap as at the rates that is available at present. I will start the analysis at what happens when markets miss not by 1% or 2% as previously, but what happens when markets miss by 4%. Instead of getting the 11.2% return that you want, your market-linked asset only provides a 7.2% return. Here, Greg would still be fine until the age of 80. And unlike the previous traditional living annuity example that already fails at 80 when it only misses at 2%, this income is not failing at such a rapid rate. Even at the age of 100, it's still close to half of what was bargained for. At a slightly better return, at a 9.2% return, the income only fails at the age of 89, close to what a 11.2% return would do in a traditional living annuity, but the income failure would again be less severe in this instance. If we compare the two scenarios, the traditional annuity and the hybrid annuity at 10.2%, the income failure points is more than 10 years apart. And at the 11.2% scenario that fails in a traditional living annuity at 90, here the income payments is off the chart. It continues past the age of 100. Same goes for the market values. Yes, it starts much lower. It's not starting at 2 million rand, but a few years later, the opportunity to leave a legacy from a hybrid annuity is much better when markets undershoot, as in these examples that I'm showing you. The reality or the question is, why does this happen? To explain this easily, I need you to think about two simple concepts. What is the difference between an income I take from an investment and the income that pays into my investment? Well, the first one hits my bank account. It empties my investment. The second one hits my investment, not my bank account. It fills my investment. The same goes for a hybrid annuity. The 140,000 Rand is the income that the client wants. That is what is asked for from the living annuity as well as the hybrid annuity. That is what is paid into his bank account. The second income that pays into his living annuity is the income from the gap. It is 62,700 Rand in the first year. This is used firstly to pay the client the 140,000 Rand, and thus only 77,200 Rand is paid from his unit trust portfolio, from his market link portfolio, that is worth 1.3 million Rand. And that 70,000 Rand over the 1.3 million Rand equates to an income of 5.94%. And this is the income that you are now effectively drawing from the market-linked assets. Not 7% from 2 million Rand anymore, but 5.94% from the 1.3 million Rand. And going back to my original chart, it's like Greg is moving from a 7% income that requires a 10% return to a 6% income that only requires a return of 9 to 10%. That equates to a 5.94% income from the market-linked assets. Now, from a technical marketing perspective, we're very excited to share this with you, and please be on the lookout for more collateral to come. And we're hoping that you can see the value of our hybrid annuity and that you would use this with your clients to enhance their outcomes in retirement. Thank you.
Thanks for sharing those wonderful insights with us, Martins. In closing, thank you all for joining us today. We hope you found the insights valuable and that you are leaving with new perspectives to enhance your approach to wealth management. If you have any further questions or need additional information, please feel free to reach out. As a wealth management team, our commitment to excellence remains unwavering, and we look forward to continuing to support you in delivering exceptional outcomes for your clients. Have a wonderful day ahead.